And it turns out I've now seen not one but two very scientifically rigorous studies that indicate to me as a professional that there's about 7% a year alpha with low beta if you invest using Islamic screens, particularly some of the effect is coming from low debt. But just in general, I'd say that if you are financing a physical thing, which is always required in Islamic finance, or there's some exceptions, you can finance someone's education, but there's a productive thing that's always being financed in Islamic finance. That's inherently a lot safer activity than if you're financing a leveraged buyout, of a company where the security is the stock or the equity of that company, which, could have a value that changes $1 billion a day, depending upon Lehman Brothers exists today or tomorrow or not. So there is actually this, excess return, free lunch at the lower risk that can be gained from investing in Islamically compliant funds. And so, there's a very large uptake in Islamic, non-Muslims of Islamic products. Similarly, on our deposit product, at different parts of the interest rate cycle, the profit sharing that we pay, which is not altered or changed by what the shape of the interest rate yield curve is, but is driven by what I would assert to be a profit rate curve, new concept for all you scholars in the community. Feel free to write a paper about it. Since the Federal Reserve can only manipulate the interest rate curve, at times the rates that we pay on profit sharing is higher than what consumer can get on traditional deposits. So we do see non-Muslims in our bank investing in the Islamic FDIC-insured deposit bank products because they can get a higher return. Now, there's other times where it's not higher, and so they tend to drift away. On the home finance side, the top subject of this panel, it used to be originally when we started out, because of all these extra regulations and costs, and Tom mentioned some of them, I did also in an earlier panel, that there was a premium and a cost to being Muslim. The products were more expensive. And in Canada, too, I understand that there was a premium originally before young Omar came forward, and perhaps there still is a small one, but as you gain economies of scale and critical mass, both Guidance and University Islamic Financial have eliminated that premium, so now it's exactly comparable. If someone comes to us and says, I want to finance my house, and they say we want to do it conventionally or we want to do it Islamically, the processing fees, the application fees, the rates are identical, whether it goes to Freddie Mac or it goes to our portfolio. It's irrelevant. So in that case, because there is no advantage, but there's also no disadvantage, we don't see non-Muslims coming to the product, but we do see some Muslims coming to the product. And as I mentioned, many non-Muslims not coming to the Islamically compliant product also. Thank you.
Thank you. I think we have time for a couple of questions. Maybe I'll lead off with a question. This is for either, I think, Stephen or Tom. With the problems that we've seen in the States in the last couple of years in the whole housing sector, where prices have dropped 30, 40, 50% in some places.
Yeah,
and I imagine
Detroit, 80%.
I was going to say, and I imagine Michigan's probably one of the worst places. How has that impacted on Islamic mortgages and their viability? And have you seen default rates comparable to conventional mortgages, or have they performed differently?
Well, first, as far as the default rates, we do benchmark to the conventional and what's out there in the marketplace, and we have seen quite favorable, if you can call it favorable, benchmarking where we have not experienced the defaults in the foreclosure rates to the extent that the market in general has. We attribute some of that just to the prudence of the homeowners, I think it was always sort of assumed that that would be the case. That at least that's what I used to hear all the time. That the Muslim homeowners were, that they had more extended families. I just used to hear very different, rationale for why that might be the case, and that premise is kind of held up through the crisis. The numbers show that, really.
Yeah, I agree exactly with Tom's comment. We had zero delinquencies, not just zero foreclosures, until June of 2007. With one exception, we had a young man who went on the Hajj, and he had asked his brother to make the payment on his contract, but his brother was negligent and did not make the payment. And so we had many frantic calls, messages, emails, text messages to the customer. And when he returned from Mecca on the 32nd day after the payment was due, rushed down to the bank to make the payment because he was mortified that he was late. But that was our first ever delinquency. But since then, we've had some foreclosures. The good news is on that, actually, not good news for the people involved, but when we started, we had no legal guidance as to exactly how the courts would treat a contract like this in the foreclosure process, and now we have good experience and legal precedent. So that's one of the unknown questions that disappeared during the crisis. The delinquencies are substantially less than our conventional delinquencies. The other thing that I'd say changed radically was we used to be able to offer products, again, with collaborating partners that offered only a 3% down for purchase of a home, and trust me, that's all gone. So, sorry for the collaborating partners; they lost a lot of money. Thank God, alhamdulillah, we did not. But anyway, so those are some major changes that we've seen in the market. And probably another one too is there just hasn't been any new competition started up in the last 3 years during the course of the crisis, whereas there was always seemed to be a new one every year that they would come and they'd have some enthusiasm and lose lots of money, and then their investors would be exhausted and they'd drop out. But we haven't seen any of those people come in lately, and don't think we'll be seeing any for the next little bit. So.